Hey everyone, hope you're having a nice day. My name's Andy and my channel is Finding Value. This clip is exceptionally important. I think it's probably the most important clip that I'm going to produce for investors. Now, this is going to go over a little bit about money creation, how money's created and brought into existence, which is, quote, inflation. I'm going to go over demographics. I'm going to go over real estate and some real estate things and how to see if it's an increasing or decreasing price environment and cycles. And then I'm going to go into ratios, which is identifying what's cheap. And I'm going to tie this all together. This is a masterpiece in my opinion. Please subscribe. Please rate this video. I'm trying to grow my channel. I'm going to give you exceptional content here. Share this with your family. Share it with your friends who are investors. This is something that is very difficult to do for most people, is to tie this all together. So let's jump in here and let's see what I've got. So you lose me. I'm going to call this identifying value and market conditions. But first I want to go over understanding our currency. So the Fed creates money through open market operations, purchasing securities in the market using new money or by creating bank reserves issued to commercial banks. I'm going to read that one last time. Creating bank reserves issued to commercial banks. From those bank reserves, they are then multiplied through fractional reserve lending, where banks can lend a portion of the deposits they have on hand, leaving a 10% reserve requirement. So they loan out 90% and they keep 10% as reserves. And I'll show you in the next slide what that looks like through a picture. Fractional reserve banking is a system in which only a fraction of bank deposits are backed by actual cash on hand and available for withdrawal. And I'm going to show you an example here. So someone deposits $100 into a bank. They then lend out 90% of that money and leave 10% in their reserves. So they make a loan that's 90% of this 100. They loan it out, they leave 10% back. Goes into a bank. Now keep in mind that they're increasing the money supply in this scenario. $90 goes in, they keep 10 back, 81. Now if you go and you add this up, this guy thinks he has $100. They keep 10 of it. Now 90 gets loaned out and they're collecting interest on this loan. 90 goes in here, they keep 9 back and they loan 81 out. 81 plus 90, you catch my drift, $171 on a $100 deposit. And what happens is you can do this 10 times and you end up $100 creating $1,000 in the system. So the commercial banks are the ones that are exploding the leverage in the system. That is where the inflation comes from. And it's very important to understand this because it affects the market conditions that we're investing under. The next one I have demographics. You've got two big areas here. You see this big boom in here? That's the baby boomers. And then you've got another big boom. That's the millennials. In the 70s, these people bought homes and had kids. And today, these people are buying homes and having kids. Do you see that likelihood? In between this gap here, we had a decline here. That's why you didn't have much inflation. Because inflation means more home purchases at higher prices. And I'm going to get into that. It's a leading in. So we need to identify value. And in real estate, you got to identify the cycle that you're in because this is going to tell us if we have an inflation or deflation cycle. And in order to see the health and the current health of the real estate market, you have to understand the metrics. I've got some metrics here, but we'll go over them in the next slide. Once you realize what the real estate market's doing, if it's inflationary, deflationary, I'm going to go over slides that are going to show this. We need to look at the ratios to find relative value and where we want to deploy our money and look for extreme valuations. So the S&P 500 to commodities, Dow to gold, gold to oil, real estate to gold. There's a whole bunch of different ratios that we can use and look at relative value to see where we want to deploy money for the largest returns. Because we want to go after those extreme underpriced valuations. So here's some real estate metrics, and I've got what they are today. So inventory is at record lows. Record low inventory all over the nation. Days on the market are very short. Housing starts barely above yearly demand, which means we are just barely going into an expansion phase. And I'm going to show you what that looks like in the real estate cycle. Foreclosures are extremely low. And the demand supply deficit is 3.5 million homes nationwide. This is huge. Now you have to keep in mind that the yearly demand for new homes is around 1.5 to 1.6 million per year. It's somewhere around that range. I'm going to go over the housing market cycle so you guys can see this. I'm going to paint this picture here. So you have to understand this first. This is a recovery phase. This is the 1.6 million line, so to speak. Then once you get above that, that is new construction, fulfilling and meeting the deficit of homes that we have out there. This is the expansion phase. Once all your metrics turn to garbage, that is telling you that you're going into a slowdown. Your foreclosures go up, your days in the market go way up, your inventory starts to be many, many, many months. And then you go into a recession, the hypersupplied recession phase. Prices decline. So another thing to keep in mind, interest rates do not affect this cycle. Interest rates do not affect. House prices don't go up because interest rates are low. That is false. I'm going to show you what causes real estate movements. This is the line that's about yearly demand. We have to get above the line to be in a oversupply state or to work off deficits. Under the line and going down is recession and then recovery, and there is your expansion phase up here. The past 10 years have been below the lowest year in 1982. All of this means that there's a problem in real estate. Remember up here in 2005, 6, 7. Remember that they were building a bunch of new homes and they had a bunch of loans that they loaned out where they should have never given those loans. So there was a ton of foreclosures that hit the market with an oversupply of new homes. It was a combination hit. This led to the lowest housing starts, like for a very, very long time. This here created a deficit of new homes on the market. It created 3.5 million to be exact. So we went into a super large recession. And now we're just coming, and I'll show you in a couple next slides, we're just coming up to that line. This is housing starts as well. And we've got recessions on here. That's these dark lines. And I'm going to show you something. I'm going to tie this stuff together for everyone. When housing goes down, notice that there's a recession, especially if you're below the 1600. It's not just normal movements, but if it gets down pretty far, recession. Now this is a quick blip. Down, recession, down, recession, down, recession, down, recession. Do you see this? Down, recession. We got a little dot-com bubble there. Down, recession. So we've got one kind of outlier, although this was coming down and maybe it was, remember, this stock market did not affect the housing market. That was one thing I wanted to point out here. And remember, interest rates have nothing to do with this. It is supply-demand imbalances. Now, I'm going to go over here and I'm going to show you. You know this piece here where we had an oversupply and a bunch of foreclosures, and then we had a huge recession. Look how low we were in comparison to everything else. They created that 3.5 million deficit of homes on the market right now. This is going to be huge on the upside. Huge. And notice that whenever we come up, we're coming out of recessions. See that? We have a little recession here because of COVID, but we're coming back up. So I've got these circles here, the green circles and the red circles. You're probably saying, well, what are those? That is your commodity to S&P 500 ratio. This is cheap for commodities down in the green. It's expensive for commodities up at the top. I overlaid that with the housing market. And what do you see? Housing boom. Housing boom in the expansion phase, and look at this. It's lining up with an expansion phase move in real estate. Do you think that's a coincidence? I don't think it is. I think this is going to be one of the biggest housing moves higher because of this massive problem and deficits back here. It's going to create a very large boom. And this boom is going to be inflationary, is my guess. If If the short-term COVID from the business failures in the commercial real estate slows it down in the beginning, fine. This is still it's still going to happen. It will just be delayed. And that's why I'm not worried about putting money in and deploying it and riding out some volatility or a down move. The stock market does not affect this cycle. Here's the crash in '01, didn't affect it. This is a crash all through here, didn't affect it. The biggest housing market boom in history right here. We're going to have one probably as big or bigger than this. And it's coming. It's coming right now. And there it is, the commodity boom and the overlay of the housing starts going into the expansion phase. Now, I have this oil price. I overlaid these bubbles here, cheap, and the time to oil. Look at how well this lines up with these. Perfect top, perfect bottom, bottom, bottom. We're at a bottom, guys. And I'm going to show you how cheap oil is right now, right? And these are massive moves. This move is massive. This move is even more massive. It's like $10 to $140. This is a 14x increase. You get some producers on that. Maybe they're leveraged 5 or 6 times to that. You're talking 90, 100-fold increases. This is going to be even bigger, and I'm going to show you. This is the gold to oil ratio. I put those same marks on this ratio. We're up here in no man's land for the cheapest basically ever. We had that fluke way up there, right? This right here is cheap. So gold is cheap to oil, or oil is cheap to gold. Extremely cheap. And guess what? Natural gas is cheap to oil. I just want to bring that up. Here's uranium. 72, 73 in 2000 was where they really took off. I'm going to go back here to the housing starts. 72, interesting. We're coming out of this recession here, going into the housing market. And 2000, that's pretty close to the bottom here. So it's just slightly delayed past these circles. I think we're going to be coming into a uranium boom pretty soon. See how it's all tying together. 100 years of commodity valuations. Scraping along the bottom, guys. This is where life-changing, life-altering investments could be made right here. Retirement in 5 to 10 years if you play this right. 20-fold increases, 30-fold increases. Possibly even 60-fold if you can play it right and you can catch a bottom. Yes, it's difficult, but you can get a 10x or 20x pretty easy out of this. Now, I'm showing energy consumption in the United States. We know that energy, we know that natural gas is extremely cheap, and we're looking at nuclear. I know that. Coal's out, renewables are in. My brother works at a utility and he's a senior manager on the design side. He says that renewables are coming in, but you can only put so much. You have to start putting natural gas plants in for a swing producer when renewables aren't performing. They also have different outputs, and they have to come in to a hub, so to speak, and then get distributed at that hub in a certain electrical format. Maybe it's DC to AC converter. I'm not 100% sure. I don't even know. I didn't ask in that detail, but the thing to to come away from is natural gas is going vertical, and if renewables aren't producing power, they're going to have to fire these natural gas generators and run them overtime. Keep that in mind. Also, more condition, stock, gold to Dow ratio. What does it look like? We are moving down, which means that gold is outperforming the Dow on the down movements here. Now, how does that correlate here? Why did this go up in 06, 07, 08? I'm going to go back and correlate something here, right? What is this top here? That's a top, and we went down. You think that has a correlation with this coming back up? I think it does. So, we also need to look at market conditions. Market conditions are affected by long-term interest rates. Inflationary periods look like this. Ones with lower or declining yields work great for other investments. And you can see a cycle here. Down, up, down, up, down, up, and down. We are at 0 in 2020. We're way down here. I have a feeling that interest rates are going to want to go higher. They're going to try to buy them and keep them low. What this is saying is that most people understand the world in a declining interest rate environment. That works great for stocks, it works great for bonds, it works great for other fixed investments. This, if we have this coming towards us and it's going to come back up, stocks, bonds, all those things do absolutely dog shit. All right? You got to be in commodities because commodities dominate in this cycle. Just dominate. So do precious metals, everything that is commodity driven. Real estate will do exceptionally well. Now I'm going to add some fuel to the fire here, right? The Federal Reserve is going to try to hold interest rates down and they're going to print like hell. What this is setting up for is real negative rates. Real negative rates are what drive commodities and precious metals a lot higher. And it's happening and they're doing it. They're going to have to continue to print and try to prop up the stock market. And I don't know if it's going to work. So the conclusion here, after I tied this all up, we have a new build home deficits of 3.5 million, and it's going to drive real estate higher, commercial real estate. I don't know about, residential real estate. Commercial real estate, I'm going to have to do a little more digging into to make sure that how that looks, because that also gets loaned, money loaned into existence for that, and businesses. And some of those are struggling. New home starts will go into an expansion phase any second now. And that's when commodities typically, at least historically, really heat up. Higher prices are going to drive inflation because that's where the money gets loaned into existence. That's that fractional reserve lending. Commodities will outperform during this cycle, in my opinion. I think we're right on the doorstep. Gold is a leader and it's outperforming stocks. We are seeing it in that S&P to gold ratio. We're also seeing it when we look at uranium stocks that are bottoming, cannabis stocks that are bottoming, natural gas stocks are bottoming. We're seeing that move and it's coming, which means it's inflationary in my opinion. We have interest rates are supposed to be held low by the Fed and base money being created. This is fuel for negative real rates. And what negative real rate is when the inflation rate is higher than your treasury bond 10-year yield. That is what real negative rates. So everyone flees bonds and they go into other investments, real estate, commodities, precious metals, anything, because you're getting a negative return on your bonds. And if inflation continues to go higher and higher and higher, and we have more people buying homes, more people spending in the millennial generation, and they're larger, I have a feeling that inflation is going to kick up because of that and home prices and the situation we are with real estate. So what are some potential investments? What can we look at? I like physical platinum, physical silver if you're risk adverse. I think you have to have platinum right now. It's so cheap. Check out my other videos. It is dirt cheap. You got to pick it up. This is no brainer. It's that cheap. Uranium's cheap. We go over that. I go over companies that might be pretty good to look into. Natural gas is exceptionally cheap. And I'm going to show you in other clips why these are all cheap. Copper's cheap. Nickel's cheap. Cobalt's cheap. Lithium's cheap. These are a renewable play pretty much. Natural gas has to come in and replace those coal power generation as a hub. Uranium, green energy. These are all minerals that go into lots of green energy. Same with these. They have the industrial side kicking way up on all of these materials. So this, if you're an investor, I just painted you a picture. It's crystal clear in my opinion. I think even if it's delayed by businesses, going bankrupt, which is deflationary, or commercial real estate having some problems, it'll just delay it. I don't think it's going to knock this thing out of cycle. There's no way with the home deficit that large in residential. It's too big. So I don't think the deflation. Now, just go look and look at the decline of the dollar and tell me how much deflation you're worrying about. Because it's straight down. It's asymptotically approaching zero. They're getting that last 1.1% out of the dollar. So I think these are going to be good plays. I'm going to give you more content in the future on how to play this. But this is just areas to look into. And if you guys have recommendations, if you know extremely good natural gas producers or copper producers or nickel producers that you're looking into and you know a lot, leave them in the comments section. I'm a facilitator here. I'm facilitating you guys learning. And if you give me feedback, if you give me good companies, you dig down and you find really good companies, leave them in the comment section and I'll present them to everybody. We are all here trying to help each other. So start to look at these, do some research in some of these companies. I'll put my picks out. Keep in mind, I am very good at doing this, the high level stuff. That's why I'm a lot in physical precious metals, because it takes away the risk of the businesses and stuff. But I also know that the returns can be ridiculously high in these companies. And I'll do more videos on how big I think some of these returns could be. I think they're going to be bigger than even uranium, some of them. And that, I think, uranium is going to be huge too. It's going to be huge. So this could be the most important clip in your investment, career that you've ever done, because this took me a lot of time to learn. So please share this video, subscribe, rate it. This is extremely important if you're an investor to understand this, because I just painted a picture that commodities are going to go crazy to the upside. So thanks for listening. Hope this provided some value, and have a nice day.